Hang on tight because you're not going to want to miss this important update. No matter how big your bag is, if you hold even a few hundred XRP or a full 2,500, what I'm about to show you could decide whether you're chasing the future or positioned to catch it. In the next 60 seconds, what you're about to hear could decide the future of your XRP holdings, and if you click away too soon, you'll miss critical information. None of this is financial advice. Always do your own research and consult a licensed professional. At the time of recording, XRP is trading in the $3.08 range. If you're watching later, price may have shifted, but the setup I'm about to break down is bigger than any single candle. Here's the part most people skim past. A hidden machine has been propping up global liquidity for years. The yen carry trade. Borrow cheap yen, redeploy into higher yield assets, pocket the spread, and repeat at staggering scale. That spread trade grew into a quiet giant. Over $10 trillion of exposure through bonds, equities, credit, and derivatives. Now imagine that machine starting to grind and slip. Japan nudges policy. The yen whipsaws. Risk managers yank lines. Suddenly, collateral that looked rock solid starts to wobble. That's how a contained corner of FX becomes a global liquidity headache. While that's happening, the world's so-called safest asset, the US Treasury market, is showing stress fractures. Depth thins at the wrong moments, yields gap on small flows, and the very plumbing that transmits dollars everywhere becomes less predictable. When the base layer wobbles, every layer above it gets jittery. Corporate debt, mortgage bonds, equities, commodities, and yes, crypto. In past cycles, central banks could flood the system with liquidity without blinking. Today, debt loads are massive, and every basis point matters to fiscal math. That's why a garden variety hiccup can snowball into a funding squeeze. So, what does a funding squeeze actually do? It doesn't just push prices around, it changes timelines. Think of it like oxygen being pulled from a room. Leverage unwinds faster. Participants sell what they can, not what they want. And in that kind of scramble, settlement speed, finality, and cross-border reach go from nice-to-have bullet points to survival mechanics. Money that moves faster clears risk faster. That's where XRP's design choice becomes the story most people miss. The reset I'm talking about isn't a sci-fi switch that gets flipped overnight. It's the moment markets admit the old pipes no longer scale. When payments take days, basis trades break. When correspondent banks stack fees and delays, working capital freezes. When the FX legs of a deal desync, risk explodes. In that environment, anyone who can compress time wins. XRP's core advantage is simple and brutal. Move value across rails in seconds, with deterministic finality at tiny cost. In a benign market, that's interesting. In a liquidity shock, it's decisive. Now layer in the tokenization wave. The loud headline is real-world assets going on-chain. Treasuries, credit, commercial paper, real estate, even music catalogs. The quiet headline is the bridge that can let tokenized value smash into legacy rails and back, without dragging settlement risk across borders. You don't rebuild the world's value stack without a neutral bridge. You don't power a global marketplace of tokenized instruments if every cross-border leg gets stuck in 3-day limbo. If everything becomes a token, everything needs liquidity, routing, and finality. That's why a 2,500 XRP holder is not just holding a coin. You're holding exposure to a potential settlement backbone. If you are enjoying this content, make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated. Stay with me for 60 seconds because this is the hinge everyone overlooks. When liquidity tightens, policymakers blink. Either they defend their currency with rate changes, or they relent and add liquidity. If Japan tweaks policy again, a violent carry unwind can force global deleveraging. Then the response is coordinated easing, guarantees, or new pipes to keep value moving. If the US tips toward cuts, the floodgates open from money markets into risk assets and new rails. Both paths favor settlement primitives. Both paths favor the assets that reduce friction. But the reset is broader than macro. It's a reputational reset. For a decade, crypto's story to institutions was speculation. Now it's cash flow, cost savings, capital efficiency, and counterparty risk reduction. BlackRock's tokenization talk wasn't about memes. It was about instant settlement, programmable collateral, and 24/7 market access. Banks aren't abandoning the system. They're upgrading it. A bridge asset that's fast, neutral, and liquid becomes infrastructure, not narrative. Let's connect that to your 2,500 XRP. In fat, easy markets, position size is all that matters. In constrained markets, positioning matters more. if corridors light up and tokenized treasuries, deposits, and invoices start to move. Across borders natively float titans. Liquidity providers stake, AMMs absorb, custodians warehouse, and exchange balances thin out. Price doesn't move in a straight line, it grinds, then it gaps. Most retail holders wait for the gap, institutions engineer the grind. That's the psychology shift you need to catch now. Here's the suspense. The shocking reset won't announce itself with one headline. It will look like small contradictory things: a central bank minutes note, a collateral rule tweak, a new pilot for on-chain settlement between two banks you've never heard of, a custody product going live at a boring institution. Each on its own is nothing. Together they are the click you hear before the bolt slides. If you got 2,500 XRP, you're straddling two worlds. The one that still thinks value clears in T+2 with piles of intermediaries, and the one that assumes settlement is near real-time, programmable, and global. One is creaking, the other is compounding. You don't need perfection. You need to be early enough that when the oxygen thins, you aren't standing at the back of the room. Don't click away just yet, because in the next 60 seconds, I'll show you how the unwind could unfold step by step, who gets hit first, and where XRP's rails can absorb the shock rather than break under it. Here's the unwind sequence most people miss. First, the yen jolts. A modest policy move forces leveraged participants to hedge hard. FX swaps spike. Dealers pull back, spreads widen. That feeds into bond basis trades. What looked like free money turns capital intensive overnight. Then collateral chains shorten, haircuts rise, funds sell the most liquid line items, treasuries, large cap equities, and yes, major crypto, because liquidity is a weapon when everyone's balance sheet is shrinking. Second, policymakers attempt an orderly path. Liquidity facilities expand, swap lines open, and guidance softens. If that works, we get chop instead of collapse. If it doesn't, we get forced deleveraging in waves. Either path elevates settlement speed from curiosity to necessity. In the chop, faster settlement releases trapped working capital. In a deleveraging, faster settlement reduces counterparty exposure hour by hour instead of day by day. Now plug in the actors that matter for XRP. In Japan, SBI isn't just a shareholder, it's a distribution artery through banking, brokerage, and payments. The Bank of Japan is exploring digital rails while trying not to detonate its bond market. A digital yen testbed plus private payment. Corridors equals ideal sandboxes to route cross-border value with a neutral bridge. At the same time, banks in Asia and the Middle East are piloting tokenized deposits and on-chain treasuries. Those flows do not want friction. They want atomic swaps, deterministic finality, and deep liquidity pools. This is where pools, AMMs, and curated corridors on the XRP ledger become a buffer. Instead of relying on fragmented, slow correspondent chains, liquidity providers can warehouse inventory on ledger, price routes in seconds, and settle across fiat legs with fewer moving parts. In a stress event, the rails that minimize the number of things that can fail are the rails that win. Don't miss this next minute because it's the single most important trigger for the reset theme. If the Fed tilts to cuts while Asia accelerates tokenized settlement pilots, we get a reflexive loop. Easing pushes capital out the risk curve, tokenized instruments demand faster rails prove cost savings, institutions increase allocation to the rails, and native assets tied to those rails reprice. The shock isn't just price, it's recognition. The market stops valuing XRP only as a crypto and starts valuing it as financial plumbing. Let's talk liquidity, because this is where small holders underestimate their leverage. Exchange balances aren't infinite. Coins migrate to custody solutions, institutional wallets, and on-ledger liquidity programs that don't sit on retail venues. Picture a shallow lake being drained slowly. At first, you barely notice. Then boats start scraping the bottom. Then a modest gust exposes the sandbar. That gust is demand from tokenized flows. ETFs and custody pipes do something subtle. They absorb supply quietly. They don't trade like retail. They settle in bigger, less frequent blocks, and they rarely sell back unless mandates change. Pair that with AMMs, parking inventory, and corridor operators holding working balances, and the tradable float tightens. Price action stays boring, then revalues in compressed bursts. Those bursts are where regret is born. Psychology splits right here. Retail watches headlines and waits for permission. Institutions count inventory and watch settlement volumes. Retail sees a chart. Institutions see a balance sheet. The more tokenized treasuries, deposits, and invoices that route through fast bridges, the more inventory is needed to grease that motion. It's not a narrative pump, it's a utility pull. Here's the phased map so you can place your 2500 XRP like a pro. Phase 1 is liquidity crunch, macro stress, forced selling, everything correlates. To 1, Phase 2 is utility scaling. Pilot corridors go live, tokenized assets settle across borders, cost savings show up in CFO decks, and rails get budgeted for. Phase 3 is institutional dominance. Custody normalizes, ETFs widen, banks embed rails quietly, and native assets get revalued as infrastructure, not a trade. We are between Phase 1 and Phase 2, the dangerous, profitable middle. All right, you've stayed locked in. Give me one more minute because the last bridge we're about to cross ties your bag directly to the reset math most people ignore, and it's the part nobody else is explaining. Let's stack the setups head to head. Bitcoin is digital gold, pristine collateral, programmatic scarcity, and a narrative that institutions finally understand. Ethereum is programmable settlement, the operating system for smart contracts, DeFi, and token issuance. XRP is engineered for something neither does particularly well at scale: high velocity, low cost, cross-border value transfer that institutions can actually use without blowing up their risk teams. In a bull market, all three can run. In a reset, only one is explicitly designed to make clogged balance sheets breathe. Macro matters. Rate cuts don't just make borrowing cheaper. They force capital out of safe harbors that now yield less than inflation. Money market funds have ballooned. As yields compress, allocators hunt. They'll buy equities, they'll buy gold. But for the first time, the rails exist to allocate into digital assets at institutional size with real custody, clear reporting, and deep derivatives. That's the liquidity wave you want to be in front of. History says expansions of global liquidity ignite the biggest crypto repricings. The difference this time is that utility rails are much closer to prime time. Now the big picture. XRP is not a lottery ticket on a headline. It's a claim on throughput. Think of it like owning a stake in bandwidth during the moment everyone moves from dial-up to broadband. When settlement speed is the constraint, assets that increase throughput capture value. That's not hopium, it's how networks monetize bottlenecks. The more corridors that require working balances, the more inventory that gets parked off exchanges, the tighter the market gets. When demand pulses arrive, they don't push against a wide, deep ocean. They push against a narrowed channel. Why do most miss it? Because the story doesn't look dramatic day to day. It looks boring. Custody launches at a conservative bank. A digital asset pilot between two mid-tier institutions. A regulatory note that clarifies reporting. Boring is where trillion-dollar systems live. The winners are the ones who can read boring correctly and act before it becomes obvious. Here's how 2500 XRP fits. In a retail mindset, that's a small stack that only matters if price multiplies. In an infrastructure mindset, that's a claim on a finite pipe right before traffic explodes. If you're waiting for the dramatic TV headline that says global reset flip switch, you'll be late. The reset happens when settlement desks stop arguing whether to test and start arguing about capacity planning. It happens when CFOs start counting cash flow days recovered by instant settlement. It happens when regulators stop debating definitions and start auditing usage. Picture the near future on an average Tuesday. A bank in Tokyo settles tokenized commercial paper to a fund in London. A supplier in Dubai receives payment in seconds from a European buyer, with the FX leg handled atomically. A U.S. treasurer sweeps excess cash into tokenized T-bills at the close and unwinds by the open without slippage. None of them think crypto. They think it just works. Under the surface, rails like XRPL keep value moving, with pools carrying the load. Every day that looks like this, a little more float disappears from the casino and enters the factory floor. The regret pattern writes itself. Most holders will sell too early and chop or buy too late after confirmation. A few will understand that the calm before structural repricing feels like stagnation. They'll anchor to the thesis, not the tick chart. They'll watch for corridor expansions, custody growth, and policy pivots. They'll treat 2500 XRP as a functional stake in throughput, not a lottery ticket begging for a viral candle. Stay with me for the next 60 seconds because here's the punchline that ties the shocking reset to your bag. When liquidity cycles pivot and tokenization goes from slide deck to daily settlement, markets won't slowly re-rate rails assets. They'll gap reprice them to match realized usage and expected capacity. That repricing always looks sudden to the crowd, but it was arithmetic all along. Less float, more flow, faster pipes, higher value for the bridge. The calm you're seeing now is not safety, it's silence before the machines spin up. If you hold only 2500 XRP, the question isn't whether that stack is big enough. The question is whether it's early enough. Because when settlement becomes a race against time, the assets that buy time become priceless for the institutions that need it. And once those institutions move, they don't come back for your coins. They come for capacity. That's the shocking reset ahead. It won't ask permission. It will reward preparation. Make sure that you like and subscribe this video. It really helps me get the message to the masses and is greatly appreciated. Have a wonderful evening, my brothers and sisters. See you again on the next one.